This is the Unit 1 for the Advanced Financial Accounting. Unit 1, Principles of Consolidation and Business Combination. Basically, many accounting standards applies for the business combination. Say, for example, the International Accounting Standard number 27, which is on the separate financial statements. So basically, a company, a parent itself, will prepare the separate financial statements. But in addition to the separate financial statements, a parent company will have to prepare the consolidated financial statement for the group. Consolidated financial statements, financial reporting number 10 applies. So basically, accounting standard number 27 is for the separate financial statement for the parent, and financial reporting number 10 is for the consolidated financial statement for the group as a whole, parent and subsidiary. Sometimes we don't only have a subsidiary, we may have associates. So associate is not a subsidiary. A subsidiary is a company in which we can control, and associate is a company in which we can exercise significant influence. So associate, accounting standard number 28 apply. For associate, we don't use consolidation. Instead, we use the equity method. Equity method is for associate. One business may combine with another business. Not all business combination results in parent and subsidiary. Basically, a business combination is a more general term. Whenever one business combines with another business, we call it business combination. For business combination, financial reporting number 3 applies. So basically, whenever a parent acquires a subsidiary, it's a kind of business combination, and therefore financial reporting number 3 applies. So that's why we must know financial reporting number 3. Not only we may have a subsidiary, not only we may have an associate, sometimes we can have a kind of joint venture. For joint venture, joint arrangement, financial reporting number 11 applies. So that's why basically for this course, we need to know these accounting standards, 27, 28, financial reporting standard number 3, financial reporting number 10, and also financial reporting number 11. In addition, there is a disclosure requirement for the business combination, consolidation, etc. So whenever you have got a subsidiary, associate, or joint venture, you have to refer to this financial reporting number 12, disclosure of interest in other entities. So if you have got an investment in other entity, you have to apply this financial reporting number 12. So as I've said before, so financial reporting number 3 applies whenever there's a business combination. And if there's a parent-subsidiary relationship, we have to refer to the financial reporting number 10 for consolidated financial statements. But basically, the company's ordinance set out the legal boundary for a group and also a group accounts. So we have to prepare group accounts, usually consolidated financial statements, because this is required by a company's ordinance. So basically, we have to prepare consolidation, or we call it consolidated financial statements, if there's a parent-subsidiary relationship. Parent control subsidiary. We call this parent the controlling entity, and we call this subsidiary the controlled entity. We use the term entity because basically it can be any form of entity, not necessarily a limited company. It can be a limited company, it can be a trust, it can be a partnership, it can be any form of entity. But whenever one entity controls another entity, parent controls subsidiary. So what's a group? A group consists of parent and subsidiary. So only parent and subsidiaries are included in a group. Therefore, a joint venture is not within a group. An associate is not within a group. For a group, we have to prepare consolidated financial statements. So basically, consolidated financial statement is prepared for the parent and subsidiary. So what is consolidation? Consolidation is the process of preparing and presenting financial statement of parent and subsidiary as if this is one single economic entity. So that's why everything of the parent and everything of the subsidiary will be added together as if this is one single economic entity. So basically, we said that we have to prepare consolidated financial statements. So therefore, a consolidated financial statements consists of many statements. We have to prepare consolidated statement of profit and loss and other comprehensive income. We have to prepare consolidated statement of changes in equity. We have to prepare consolidated statement of financial position. And also we have to prepare a consolidated statement of cash flow. So at the end of this course, we should be able to prepare all these consolidated financial statements. So we got definitions here. So under financial reporting number 10, we define a parent. And a parent must prepare consolidated financial statements in which it will consolidate all the results of the parent as well as the subsidiary. So under Hong Kong Financial Reporting Standard number 3 and Hong Kong Financial Reporting Standard number 10 was a parent. We got a good definition. A parent is an entity that has subsidiary. Good definition, but basically it tells you nothing. So what's a parent? A parent is an entity that has subsidiaries. So what's a subsidiary then? A subsidiary is an entity that is controlled by another entity. So a subsidiary is an entity that is controlled by the parent. Seems it tells you nothing again, but basically we got one more word, which is control. So a subsidiary is controlled by the parent. So take this as an example. If we have got one entity, parent here, which control the subsidiary, this is a parent-subsidiary relationship. Normally, it's easy to demonstrate control. Once you have got more than 50% of the voting right, once you have got more than 50% of the ordinary shares, basically you control. No one will argue unless you got some evidence otherwise. Otherwise, usually if you have got more than 50, you control. Remember, the magic number is more than 50. It's not only 50. If this is only 50-50, it can be a deadlock, right? So you must have more than 50. So that's why no one else can control. You got more than 50. Therefore, you control. So in this case, if the parent has got 50.0001%, therefore the parent controls the subsidiary. The other shareholders at maximum can only have 49.9999%. No matter how long the line is, 49.999999, it will be less than 50. Therefore, they can never control. So this group of shareholders who cannot control, we group them together. We call them non-controlling interests. Okay, so there's only two parties. Parent, which is the controlling interest, and the other shareholders, they are non-controlling interests. So non-controlling interest is the equity in a subsidiary not attributable to the parent. If you are not the parent, then you are grouped under non-controlling interests. So what is control? Control. Basically, Financial Reporting Standard number 10 define that an investor controls another entity if and only if the investor have got all the three items: the power over the investee, the investor is exposed or have got the rights to a variable return from its involvement with the investee. That means the return. The most important thing is the item 3. The investors can use its power over the investee to affect the amount of the investor's return. There's a linkage between the power and the return. So he can use the power to improve the return. So basically, we need to go through these 3 items one by one: power, returns, and the linkage between the power and the return. So what is power then? Power is the current ability to direct the relevant activities. So you got the current ability to direct the relevant activities, then you got the power. Usually this kind of power can be considered from the voting right. If you have got the voting right, you got the power. We consider this power even if the right to direct is not yet exercised, but still if you got the current ability to direct the relevant activities, this is your power, even though you choose not to exercise yet this power. Say for example, we may have an entity. There can be many activities. They can have trading, manufacturing, sales, research and development, everything. Different entity may have so-called different relevant activities. So relevant activities is the activities that most significantly affect the return of the investee. For pharmaceutical company, maybe the research and development is very important. So therefore, the party who can control, who has got the power over the research and development, is the one who can have got the power. If this is just a trading company, sales and marketing may be more important. Therefore, the sales and marketing can be the relevant activities. Different entity has got different so-called relevant activities. So it depends on the nature, it depends on the business of the entity. So first thing we have to decide is, we have to decide which one is the relevant activities. That means the activities most significantly affect the return of the entity. Then the investors who can have got the power over these relevant activities is the one who have got the power. Usually, we don't argue. If you have got more than 50, you got the power. Right? If you have got more than 50% of the voting shares, you got the power. But sometimes we will consider, even if you have got less than the majority, we say that you have got the de facto power. You have got the power in fact. So we may consider many other circumstances. Say for example, we may consider the agreement with other vote holders. We may consider any other contractual agreement. We may consider the size and dispersions of the holding right, and we may consider also the potential voting rights. So we'll go through all this bit by bit.